How this sets us up, though, for a cold winter, that's really then the question. Joining us to help us answer all of this question as we wind up having oil still over 80 is Ed Morse, Citi Global Head of Commodities Research. Ed, you heard me say that we saw a draw across the board from Cushing overall inventories as well as distillate and gasoline inventories. What's the state of play, supply and demand wise, here in the U.S.?
It's very, very tight. We're having inventories pulling down to lower and lower levels. And it's not just in the U.S., but it's across everything we can observe in the world of inventories. And you mentioned the weather. The numbers we like to look at is days of forward coverage of inventory. We're kind of at the margin below a healthy side. Healthy would be above 55 days of forward coverage. You get to 60 and over, that's where we were. I'll remind you, it was April of last year that we ran out of storage and oil prices went negative. No place to put it. But this time we're worried with a cold winter that days of forward demand coverage could, for the OECD as a whole and for observable inventory, get down to 50 days. That's almost unheard of. So it's the exact reverse of 14 months ago or 15 months ago.
Ed, you guys are fine over there. You guys are an energy island. It's the rest of us that are having problems. What do you think the outlook's going to be here in Europe and in Asia?
You're absolutely right, Guy. I mean, we are an island. We are mostly self-sufficient. We're absolutely self-sufficient in natural gas. So while our prices went down a little bit below $5 per million MBTU, you get to spot prices of LNG in Asia. It's been hovering around $33, $35, and the same price level in the heart of Europe. TTF is about the same as JKM in the Asian sphere, and your NBP prices are way up there too. So yes, it is a very tough entry to winter for most of the rest of the world.
Well, we'll get to that in just a second. I just want to go back to Guy's point. He always says this to me: you guys are fine. You're an island. You're going to be energy independent. You have all this oil and natural gas, but we're not actually producing it. So why do you think that price signal is so broken?
Well, it's partly broken. It's not fully broken. It's the discipline of the publicly traded companies. The privately owned companies are really ramping up their drilling activity, and we're seeing it. I don't know what the production number was from the EIA today. If you tell me what it is, I can comment on it. But we're getting the return of everything shut down in Hurricane Ida, and we're well above the low point. So I think we're about to see a year ahead, which is going to look more like 2019 than 2020 or 2021. We're going to see order of magnitude 1,300,000 or 400,000 barrels a day of U.S. production growth, if you include NGLs, the liquids that get produced along with natural gas, along with crude oil. So I think the drilling has kept up enough, and I think it's going to continue to increase at a rate, and we'll soon see the public companies adding to what we've already seen in the privates.
Well, Guy, let me just jump in, because production was actually just 100,000 barrels a day short of the high that we saw before in Hurricane Ida. So to Ed's point, Guy, yes, we are producing more oil here.
And the Permian is just about as what its former peak was.
True.
Yeah. So back to my point, you guys are fine. We over here, less so. Ed, what does the worst case scenario look like in Europe this winter?
The worst case scenario for Europe, and we've had like a half a dozen of these in the last 30 years, if we have weather like we've had a half a dozen times in the last 30 years, Europe will run out of natural gas available in inventory. And God knows what the price means, because it means you've got to hit a price that really rations consumption to get the market even. So double or triple today's prices is well within the realm of reality. So yeah, $100 natural gas and the electricity equivalent of it if weather is really, really cold.
Okay, so let's just actually point this out. We stole this chart from your most recent note, Ed, and it shows the different drawdowns in inventory in Europe for natural gas based on how cold it's going to be. And this is the scenario you're talking about, which is we're assuming a really cold winter of 2005, 2006. You're looking at below zero BCM storage. That means your inventory is depleted completely. But in a better case scenario, we're still relatively depleted here. So I'm just wondering how quickly you think that Europe can stock up if, say, we have the average of the last 4 years.
Well, the question is, where is the inventory going to come from? We know that the main source of supply is no longer LNG. all of the LNG that's available in the world has been taken up, and the Chinese have gone into a bidding war with whatever available extra barrels, extra molecules there might be. So nothing is going to come in by the way of LNG. A little bit maybe if hydro turns in Brazil and the U.S. LNG going to Brazil today switches to Europe, that could happen. But we're not talking about a lot of natural gas that way. And so far, the Russians have been facing the same problem everyone else: low inventories because of the high temperatures in the summertime. So they couldn't produce enough to fill up their own inventory, let alone Europe's inventory. And the Russians say sometime in November, is that November 1st or November 30th, that the Russian supplies are going to get flowing again back into Europe. And that will make a huge difference. But like the weather, we don't know what the Russian supply is going to be.
Maybe it's just next November, not the one coming, the one after that. What can China do? This is a key question. China is trying to manage the markets, trying to basically change the landscape. It is focusing on coal. It is trying to manage the price there. How in control do you think the Chinese authorities can be of their own destiny when it comes to energy prices this winter?
Well, here's the rub, Guy. They can be in pretty decent control. They can, as they have already, either rationed or cut off electricity to certain industries that are heavily energy intensive. And yes, you're looking at our chart of where coal inventories in China were at the beginning of winter. So what they can do is really hurt the economy. They can subsidize industry to shut down, pay the workers. But the shutting in of industry, energy-intensive industry, that's aluminum, copper, zinc, other things like that, cement that are impacted by it. And that means lower rate of growth. Our own economists have already dropped our expectations of Chinese growth for this quarter by 0.5%, down to 4.5%. They may have to double down on that depending on what's going to happen in terms of industrial availability of electricity over the wintertime in China.
So, Ed, before we let you go, I have to ask about the copper market, because it does also feed into the China story. We've seen record backwardation on the LME. We've seen record stock draws. Trafigura had to drain a lot in order to meet client demand. This is intensely unusual. Do you think that what we're seeing here with copper is an idiosyncratic thing, or do you think that this is what we're going to start to continually see as we go through this green energy transition?
Copper is a particular problem in that we don't know where the supply is going to come from. The supply that we can identify is much more expensive than the average supply of copper. So whatever happens in the near term, yes, rising prices right now, probably dropping by the time we get to the end of winter. But the issue with copper is that the incremental molecule that's of demand goes into a greener planet. It's more than half of our expected copper demand, which will be incremental to today's demand, is based on greening of the world. And copper is really a part of that for the time being. So copper prices will go up again. Yes.